What do you make of the landscape right now? There are headwinds when it comes to regulation. There are headwinds when it comes to macro environment. When we're thinking of inflationary pressure, can technology still be an area to be over-allocating to?
The short answer is yes. We're very positive still on technology, but you have to be very selective. In particular, you have to have the valuation discipline always, but more so at this stage in the cycle when we're heading into a potential risk of slowdown or potential recession. That discussion around recession risk has receded for this year, but we believe that when we're looking into 2024, there are headwinds that could make the economic landscape more uncertain. Notably, we've got the US economy with grappling with rates that have increased quite rapidly. We've got the Chinese economy as the second largest economy globally that is starting to lose momentum, and there's uncertainty about next year after the initial recovery that we've seen this year. So there are a lot of things to grapple with on the economic front.
You've grappled for years before. We've had downturns. I know you come from very senior roles at BlackRock. You waded through 2008 financial crisis. You've been there, done that. And therefore, with that sort of mindset, do you have to be allocating into mega trends? Do you have to be thinking about valuations even with the optimism around AI? I mean, is Nvidia just too extraordinarily highly valued now?
Yeah, so there are a few things that we'd want to highlight. Firstly, on valuation, we want to remain disciplined. So we use a discount rate that is capturing some of the potential for rates to be longer, higher for longer. So we've got an assumption of 5% for our risk-free rate in the long term. And this is something that we've been assuming for a long time. So even when rates were at zero, close to zero, negative in some economies 18 months ago, we used the assumption that monetary policies would normalize and rates would go to initially 4%. And then last September, we increased our assumption to 5%. And that was on the basis of an assumption that inflation was going to be stickier and longer lasting. So we're assuming a long-term inflation in our models of 3%. So that's on the economic side and on the valuation front. Then in terms of mega trends, you're absolutely right. The way we look at opportunities going forward is looking at three mega trends: demographic changes, future of technology, and resource scarcity. And these are mega trends we'll be talking about for the next decade, 2 decades, 3 decades. They're here to stay. There are themes that are evolving within those mega trends, and AI is an important one in particular. But generally speaking, that permits us to put our client strategies on long-term structural growth opportunities, looking forward rather than looking backwards. Then on to your third question, which is around Nvidia and AI and valuation around that. Our view is that you have to focus on companies that have a profitable profile. We look at that as companies that have high returns on invested capital, improvement in returns, as well as an attractive growth profile. And we like that growth to come from revenues, not just profits. So when you look at a company like Nvidia, we forecast sales growth at Nvidia of about 30% annualized over the next 5 years. And when you look at the bottom line, we're looking at closer to 40% annualized over the next 5 years. So then when you're looking at the valuation of the stock, even just taking the PE, a PE 12 months forward of about 30 times, you look at a company on a PE to earnings growth ratio over the next 5 years of less than 1. So that to us, as a rule of thumb, can argue that Nvidia still has strong valuation support.
Zehrid, it's Ed in San Francisco. It's good to see you, and thank you for making it through the storm in New York City to join us on the program. On that assumption that you just outlined, I think it's so interesting because there's an element of surprise that some of the other mega caps, entrenched market positions, big balance sheets, also get hit, right? That you outlined this assumption that the rest of the market has higher for longer. Does the case for being overweight a name like Apple or another mega cap hold up in a world where treasuries are pushing 5%? Do you see what I mean?
Yes, you're absolutely right. Hi, Ed. So there's a few things to bear in mind. Yes, quality growth companies such as Apple, such as Nvidia, which we define as high returns, high growth profile generally, tend to be impacted negatively by rising rates or rising rates expectations, because these are long duration names. But there's a few aspects to mention. Firstly, as you've got rising rates, you've got potential risk of economic cycle turning more negative. And in that instance, we want to have companies that have both structural growth exposures, because that permits them to generate their own weather at a time when growth could be challenged at the economic level. Secondly, companies that have strong balance sheets, because if we're heading towards a sharp slowdown or potential risk of recession, you want companies that have solid balance sheets. Thirdly, companies that have pricing power, because in a higher inflation for longer environment, companies with pricing power will be able to better protect their margins. And fourth, companies that have resilience in terms of earnings downgrades, because we still have the view that there's going to be ongoing earnings downgrades. So we want to be in companies that either resist those downgrades or are able to actually quite at the opposite, surprise on the upside. And so when we look across some of the technological landscape, we do find companies that have all those characteristics, and that's the ones we want to focus on. So yes, nearer term, the market will always have the knee-jerk reaction of selling down or selling out of quality growth companies as rates increase because of them being longer duration and therefore more sensitive to rates. But as you think about the second round effect of higher rates bringing potential risk to the economic cycle, you want to be in exactly those companies that can weather that storm.
Zehrid, we've gone so macro. I just want to go micro for a minute because I know you follow Nvidia very closely. The news 24 hours ago was that France's regulator raided Nvidia's Paris offices in a sort of antitrust action. Does something like that concern you?
We did see that there was that antitrust raid. At this stage, we're still taking stock of that news. We do have a consistent assessment of companies in terms of risks, and in the company risk section, we have an element of regulatory risk assessment. We rate our companies from 1 to 5, 1 being low risk, 5 being high risk. And in the case of Nvidia, we have a risk rating on the regulatory side of 3, so neutral generally. So we're going to be keeping an eye on this specific news, but at this stage, we are not able to comment any further.
You can go so global for us, though, and I like that you mentioned China as a macro headwind. China on the geopolitical and micro perspective as well is going to be impacting the likes of Nvidia, of, well, any company, Tesla with an exposure to China. How do you think about that in your risk modeling?
It's an important focus for us. So you asked earlier about mega trends, but within those mega trends there are themes, and there are 8 themes that we particularly focus on going forward in the midterm. 4 of them are actually related to that technological and potential geopolitical uncertainty. And the biggest one is what we label technological and geopolitical fragmentation. And that comes from that risk around Taiwan and the China ambitions around Taiwan, the US and the European approach to that territory, the need to actually manage that geopolitical risk by the governments, and therefore the US encouraging TSMC to build a plant in their territory, Japan doing the same. We believe Europe will be doing the same. That's leading to technological fragmentation. There are potential challenges from that for companies like TSMC, but there are also opportunities. So for companies like ASML, we believe that that technological fragmentation will be a benefit, because where they were shipping their tools to Taiwan, they'll be shipping some to each of those territories as those factories become live. And that will create some boost to the top line as well as scale economies, which will also enhance the profitability of that company.